single piece of forgotten financial history might be the most valuable thing you hear all year. Stay with me, because by the end of this video, you're going to look at your own mortgage very differently. Picture America in January of 1934. The Great Depression is in its fifth winter. Bread lines, closed factories, foreclosure signs on every other street. According to the U.S. Department of Commerce that month, 45% of all urban homes with a mortgage were in default. 45%, almost half of every working family who owned a home was about to lose it. And here's what most people don't understand about why. The mortgages of the 1920s weren't the 30-year fixed-rate loans we know today. They were 5 to 10-year balloon notes. You'd pay interest only for a few years, and then the entire principal came due. You either paid it in full, or you renewed it. When the bank started failing in 1930, 31, 32, those renewals froze. The bank closed, the note came due, and the family lost the house. That's the world working Americans were living in. And then, in the span of 6 months, two things happened in 1934 that completely rewrote the rules of debt in this country, and almost nobody connects them. January 30th, 1934, President Roosevelt signs the Gold Reserve Act. On its surface, it's a gold law. Underneath, it's a debt law. Overnight, the dollar is devalued by 41%. The price of gold is moved from $20.67 an ounce, where it had been for over 100 years, up to $35 an ounce. Now here's the part the history books gloss over. The official, stated goal, written into the economic policy memos of the Roosevelt administration, confirmed in the National Bureau of Economic Research's own historical papers, was, quote, controlled inflation, to lighten debts in real terms. Read that again. The United States government openly admitted in writing that the purpose of devaluing the dollar was to make debt easier to pay off, by making every dollar you owed worth less than the dollar you originally borrowed. That's not conspiracy. That's the policy. And then 5 months later, in June of 1934, Roosevelt signs the National Housing Act. The FHA is born. And for the first time in American history, working families can get a long-term, fixed-rate, fully amortizing mortgage with no prepayment penalty at 5% interest. Two laws, 6 months apart. One devalues the dollar. The other locks in long-term, fixed-rate debt. The smartest families in America put those two things together. Most didn't. Here's what they figured out. If the government is openly engineering inflation and you have a fixed-rate mortgage, then every dollar you pay back tomorrow is worth less than the dollar you borrowed today, which means paying that mortgage off early, sending extra payments to the bank, was the same as voluntarily giving the bank stronger dollars when you could have given them weaker ones later. The banks understood this perfectly. That's why they pushed early payoff. They knew exactly what their loan books were going to be worth in real terms 10 years out. So the smart families did 3 things, and these are documented in the lending records of that era. 1. They paid the minimum, not a penny more. Every spare dollar that would have gone to extra principal stayed in the family's hands. 2. They converted that freed up cash into hard assets: farmland, tools, livestock, productive equipment, small businesses, even silver coins. Things that hold purchasing power when paper doesn't. 3. When HOLC and FHA refinance programs opened up, they stretched their mortgages out as long as possible: 15 years, 20 years, eventually 30. They wanted that debt locked in for as long as the dollar would lose value. By 1945, 11 years later, those families looked up. The $2,000 mortgage they were still paying on was being paid back in dollars worth a fraction of what they'd borrowed. Their homes were paid off in cheap money. Their hard assets had appreciated. Their neighbors who'd done the responsible thing and emptied every spare dollar into early mortgage payoff had nothing to show for it. That is the lesson nobody teaches. Now look at where we are right now. You have inflation that's been running hot for 5 straight years. Real inflation, not the official number, is eating purchasing power every single month. You have a federal debt north of $36 trillion that this government can only inflate its way out of. There is no other path. The math doesn't allow one. And millions of working Americans are sitting on 3% and 4% fixed-rate mortgages they locked in between 2020 and 2022. That mortgage you have at 3.25%, 4%, 5%, it is the exact same gift the smart families got in 1934. It is fixed, it is long, it is below the real rate of inflation, which means economically you are being paid to hold that debt. And the personal finance industry, every guru on YouTube, every banker in every branch is going to keep telling you to throw extra money at it. Pay it down, be debt-free, sleep better at night. That advice is correct for high-interest credit card debt. It is dead wrong for a sub-inflation, fixed-rate mortgage in an inflationary decade. The banks already know this. They are quietly offloading their low-rate mortgage paper as fast as they can. Read the financial press. Watch what they do, not what they tell you to do. If this changed the way you see your mortgage, do me a favor. Subscribe to the channel, hit the bell, and drop your mortgage rate in the comments. I'm reading every single one. And if you want the deeper story on the 1933 bank holiday, the one your bank still doesn't want you to know about, that video is right above this one. Standard reminder, I'm Marco Valenti, not your financial advisor. Everything in this video is historical analysis and general financial education, not personalized advice. Talk to a licensed professional before making any decision about your mortgage, your debt, or your investments. As always, stay focused, stay consistent, stay elite.